How do you know when an investment strategy has actually stopped working? And when you're simply going through one of the periods where its weaknesses become visible? I've been asking myself exactly that question recently. My wheel portfolio is up about 2%. Over the same period, the S&P 500 is up roughly 13%. If you'd simply bought the index instead of following my process, you'd be ahead by about 11 percentage points. So what do you do with that information? Do you conclude the strategy doesn't work? Or do you conclude you're measuring it the wrong way? The answer starts with understanding what the wheel is actually designed to do. I sell cash-secured puts on companies I'm willing to own, and if I'm assigned, I manage the position by selling covered calls. In a strong bull market, I don't expect that process to keep pace with an index that is fully exposed to the upside. That's one of the trade-offs built into the strategy from the beginning. So when I look at the data, I see two stories at the same time. The first is straightforward. Over this period, the S&P has produced the better return. The second is that the strategy has behaved largely as I expected it to. I've collected premium, taken assignment on companies I was comfortable owning and, as expected, given up part of the upside because that's how the strategy works. Those observations aren't contradictory. Now we can come back to the original question. The question isn't whether the S&P outperformed. The question is whether that means the strategy is broken, or whether this is simply the price of using it. The real question comes after investors look at numbers like these and ask what they should do next. I don't think the biggest risk is underperforming the S&P for a period of time. The bigger risk is what often happens right after that. Abandoning a process simply because another one has recently produced better results. That's how many investors end up changing direction every few months. First, they're selling options, then they're chasing momentum, then dividend stocks, then value, then leverage. The strategy changes, but the motivation is often the same. They're responding to recent performance rather than following a consistent investment process. The result is that they experience the difficult phase of almost every strategy without staying with any of them long enough to benefit from its strengths. So my conclusion isn't that I suddenly need a different strategy. The question I ask myself is much more specific. Did this period expose a flaw in my assumptions? Was there something wrong with my position sizing? Did I accept assignment on companies that I no longer believe deserve a place in the portfolio? Or is this simply the strategy behaving as expected in a market that strongly favors passive index exposure? Those are very different questions, and they lead to very different decisions. That review is ongoing. I go back through every assignment and every covered call, asking whether I would make the same decisions again knowing what I know today. If the answer is no, then the process needs to improve. If the answer is yes, then the result may simply reflect the trade-offs of the framework rather than a flaw in the framework itself. Which brings me back to the original comparison. My wheel portfolio is up about 2%, while the S&P has returned roughly 13%. There's no reason to hide from that comparison. But I also don't think it tells me to abandon the framework. It reminds me what I'm giving up by choosing this framework in a market like this. Less upside, more disciplined entries, and premium income instead of full participation in the rally. That's the trade-off I accepted when I chose the strategy. And more broadly, I don't think there's an investment approach that delivers attractive long-term returns without a price attached. That price may be volatility. It may be years of underperformance. It may be the discipline required to stay with a process while another one is doing better. I don't think there's a version of investing where the returns are attractive and the psychological burden disappears. The discomfort simply changes form depending on what you're doing. This is the point in the cycle where the cost of my choice becomes visible. The comparison matters. The discipline is resisting the temptation to abandon a process simply because another one has produced better numbers over the last several months. The important question isn't whether the strategy is being tested. Every strategy is tested eventually. The question is whether the outcome has invalidated the process, or whether it's simply revealed the cost of following it. If you'd like to understand the strategy in more detail, watch this video next. And if you want to follow every trade as it happens, you'll find my newsletter in the description.